Hi traders, you are welcome back to the Forex Geek channel. In this video, we are breaking down a complete SPX 500 trading strategy that will help you navigate market moves with more confidence and precision. Okay, so the SPX 500, also known as the S&P 500 index, it tracks the performance of the 500 largest publicly traded companies in the United States. Now, because of its high liquidity and steady volatility, it's a favorite among traders. But like any market, it requires a structured approach to trade effectively. Okay? The first step in our SPX 500 strategy is identifying key support and resistance zones. All right, these zones are super important. You need to identify your zones. Okay, key support and resistance zones. Highlight them on your chart. Okay, just to point out a few. So these are price areas where the market has reacted multiple times before. They act as decision points, places where traders need to watch closely for either a reversal or a continuation. Now, on higher time frames like the 4-hour or the daily chart, you have to mark these zones clearly, right? They will serve as your main reference points for intraday trading. Now, let us talk about market structure. Understanding whether the market is in an uptrend, a downtrend, or a ranging market is essential, right? You need to clearly identify if the market is trending upwards or trending downwards or consolidating. In this particular example, we can see that the market is clearly trending upwards. Okay, so in an uptrend, you'll be looking for higher highs and higher lows, just like what we can see happening here, right? Then in a downtrend, you'll be looking for lower highs and lower lows. Okay, looking for lower highs and lower lows in a downtrend. All right, in an uptrend, you'll be looking for higher highs and higher lows. All right. So market structure tells you the overall direction, helping you avoid trades that go against the dominant flow. The third step is spotting liquidity zones. All right, these are areas where a large number of stop loss orders or pending orders are likely sitting. The market often moves to these areas to collect liquidity before making its real move. All right, so recognizing these zones can prevent you from entering too early and getting stopped out unnecessarily. Once your zones are in place, all right, once your zones are in place, and the market structure is clear, it's time for entry confirmation. So for SPX 500, this could be a candlestick pattern like a rejection wick. Like if you look now, you would see that this is a zone that I marked out. And you can see price got rejected here again. But at this particular point, there was a push below that level. Now, this might be a liquidity grab. You can see how I highlighted this zone. But right after price broke below here, if you are a breakout trader, you might have jumped in to sell. Unfortunately, this was not a sell signal. This was, a false breakout. And smart money might have grabbed liquidity from here only for the price to reverse back. Okay, so that's the reason why once you identify your zones, always make sure you look out for confirmation patterns. Okay, so for your confirmation patterns, you can look out for candlestick pattern, like maybe a bullish engulfing, like what we can see happen here. Maybe a bullish engulfing, or maybe a rejection week, right? Or a break of structure followed by a retest. You can see now we actually had a bullish engulfing here, and we still had a retest of this zone. Can you see a retest of this zone, and then price continued going upwards. So always wait for confirmation before pulling the trigger. Patience is a trader's best weapon. Okay, you must be patient. This is a game of patience. All right, if you are not patient, you will lose money unnecessarily. All right, so you have to always wait for your setup to show up in the market. Make sure that all the necessary prerequisites and requirements have popped up in the market before you proceed to entering your trade. And always observe proper risk management as well. It's very, very important. It should be non-negotiable. Finally, manage your trade wisely. Use stop losses. All right, and your stop losses should be based on recent market swings. For example, if we are going to enter a buy trade here after we got this break and retest, so we enter the buy trade around here, your stop loss can be below this zone, all right, this liquidity zone. Okay, and then for your targets, you can actually decide to use the next important zones, key zones. For example, you can use this resistance as your take profit. Your take profit target. You can use that as your take profit target. All right, that resistance zone you can use as your take profit target. That's for a buy trade, obviously. For a sell trade, you can use support zones, important support zones for your take profit. Okay, do not overcomplicate your charts with unnecessary indicators. You can just stick with price action and keep it clean. So if you apply this approach consistently, you'll find out that your decision making will likely become clearer and your trades will be more structured. Okay, so it's important to apply the strategy the right way. So if you found this breakdown valuable, hit the like button, subscribe to the channel, and turn on notifications so you don't miss future market breakdowns and strategy guides. Your support keeps these deep dive tutorials coming. Okay, thank you for watching, and I look forward to seeing you in the next video. Happy trading.